Margin debt from investors continues to rise at a record pace. We are at record levels, went up again last month as well. Is this a sign of, hey, there's good opportunities out there? Or is this a sign that you should be careful and cautious about what could lie ahead? I've got some perspective coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notification, and smash that thumbs up button. All right, check out this headline here. We got in the month of March 2021, margin debt levels increased another 1.1%. We've been hitting at all-time highs. It increased again. We are at all-time high record margin debt. Is this a good thing? Is it a bad thing? Is it a scary thing? Is it a calming thing? You might say, well, that's obvious, but let's break it down. What is margin debt? Okay, so when you open a brokerage account, which is just when you open an investing account, you have the opportunity to buy your investments using your cash, or you can buy your investments on margin, which means you can buy your investments using borrowed money. And so, okay, well, how can I borrow the money? Well, when you open up your account, you can set it up as a margin account, and your brokerage firm, which Fidelity or Charles Schwab or TD Ameritrade, or I'm just going to say it, I don't want to, Robinhood, who takes data from their investors and sells it to hedge funds. Your brokerage account, the manager says, here, you're allowed to have this much debt, and you can buy this many securities on margin. Oftentimes, this is you have, let's say, $100,000 in your account. You deposit $100,000 of cash, and let's say, for example, your brokerage company says you can have 50% margin, which means you now have $150 worth of securities that you can buy. Okay, does that make sense? 100's your own money, 50 is what was loaned to you from the brokerage company, and now you've got more money that you can invest and so on. Now, you do owe interest on that margin loan. There are fees attached to it, and because obviously you don't get credit, you don't get loans for free, but there is some interest that you pay for that leverage. So that's how it works. That's how margin debt works. What are the pros and the cons? I mean, there's the obvious pro is, hey, when the market's going up, you can borrow money at lower interest rates and invest it and earn a higher rate, right? So when the market's going straight up like it has for the past 12 months, my goodness, margin debt, wonderful. That would be what I would call leverage. I've done videos about, is debt leverage or is it bondage in the past, and I would call that leverage. That's if the market's going up. The risk is if the market starts going down, or if the stock that you invested in or the position you invested in starts going down. That amplifies the risk, okay? Well, how does it do that? Because when you borrow money, and let's use that example, and I'm not going to break it down all the details, but just for example, you deposit $100,000 into a brokerage account. You turn on margin. The margin says we'll give you $50,000 extra. Now you have $50,000 of debt that you can borrow against. So your ratio, your debt to equity ratio, you've got 100 of your own money. You've got 50 of debt. Okay, if your brokerage company is going to say that's your current ratio. If your ratio gets down below a certain level, then we're going to need you to deposit more cash. They call that a margin call. And so how does that ratio get impacted? How does that ratio go against you? Well, if your investments start going down in value, yeah, you put $100,000 in there, you borrowed $100,000 of margin debt, but now it's only worth, $75,000 because your investments, lost 50%. Like you bought Zoom at the wrong time and now it's down 44%. You bought Bitcoin at its highs and now you're down, 25%, something like that. Okay, so and I'm pointing those out because even surging investments that have worked, phenomenally for a certain period of time and have had spectacular returns can go negative, can cool off very, very quickly. And so if you're looking at this saying, geez, Tesla has just continued to rise, or Zoom is continuing to rise, I'm going to jump on that, and not only will I jump on it, I'm going to use levered money. I'm going to use margin debt to jump on it. If you happen to catch it late and it starts going down, now that's going to impact your ratio, and you could get this nasty email from your brokers or your brokerage company saying, hey, you need to deposit more money. And you might say, I don't have more money to put in there. And so what do? Well, you start selling investments to pay off that debt, to pay off that loan, so that your ratio gets back in alignment to where it's required to be. And when you and others sell investments all at the same time, what happens to the stock price? If you're just doing it and your neighbor or just your community, say your entire neighborhood decided to buy Tesla at the same time, and now you're getting a margin call, your neighborhood selling, no big deal, no big deal. But if an aggregate millions of investors, or even 100,000 investors, or people with significant amount of money have all levered up, if there's lots of margin out there, and the market starts turning against you, and everyone's getting margin calls, everyone's needing to sell at the same time, what does that do? It accelerates the selling, accelerates the downward pressure and the downward push, and it creates more bubble because I've got margin, and therefore on the upside, we're enhancing our highs, as you can see in some of these charts I'm going to share with you. We're enhancing our highs above what they should be because we're using borrowed money to get there. And then we're enhancing our sales, our negatives, our downside, because now we've got all this margin, we have to sell twice as much or even more, which is creating more downward pressure. Guys, margin is actually creating bubble and burst type scenarios, okay? So that's what margin is. That's how it works. That's the good and the bad. Where are we at right now? I already told you, we are at record levels. Look at these charts here. Guys, we hit a record level for margin debt in 2018 compared to 2007, compared to the tech bubble. But you would say, well, of course, there's more money out there in circulation. The overall economy, the overall market is worth more. We should, during booming periods, we should have higher levels of absolute margin debt. Yeah, of course. So look at this link below. I don't know how many charts we can put up here, but use the link below in the description to geek out on this, because even in absolute measure, we are far surpassing record levels of margin debt. So what does that mean? It means, and this isn't a prediction of what the market's doing. It's not an edict of what's happening in the market. What this means is borrowed money has helped to inflate stock prices faster than they might naturally have risen, okay? And if and whenever this thing turns, there will be amplified selling, which will push stocks down below or faster than they otherwise would be. The margin debt means bubble and burst scenario. It just does. And the fact that we're at record high should be somewhat alarming, somewhat cautionary to all of us investors. Does this mean I got to go sell everything? I've got to put my money under the mattress? Absolutely not. Absolutely not. Just means you should be on your guard, okay? You should be careful. Don't be surprised, and don't. So I guess here's the thing. Don't be surprised. Don't take on margin debt yourself, okay? So 3 action items I would tell you. Number 1, make sure that you're taking the right level of risk for your overall financial situation. Build out your comprehensive financial plan, and then see how much risk you should be taking, and take that level of risk, okay? So that's number 1. Number 2, make sure that you've got a diversified investment strategy. And what I mean by that is you're using more than one strategy. Don't have the only strategy just be cryptos. Don't have the only strategy just be S&P 500 index. Don't have your only strategy just be diversify, buy, and hold. What we recommend is a diversified buy and hold that's consistent to your financial plan, plus a momentum strategy that can pivot and adapt when market environments change. Because if we're seeing this expansion of the market because of all the margin debt taking on all the leverage, you want to participate in that when that's going up, right? And your momentum strategy will help you do that. And then if this is a bubble, if it does pop, if it does change very quickly, that adapting, that momentum strategy we call dynamic will pivot, will adapt to those changing market environments. So that's the second thing. Make sure you're taking multiple strategies. I would tell you make sure you're using the momentum strategy, okay? Third, I would tell you don't use margin debt. I would tell you don't, out of principle, don't invest on margin, okay? Just simply because of the risks. You could argue, well, wait a second. Mike, you believe in long-term capital appreciation, you believe in the markets. So if you believe in that and you're willing to invest in that, why not invest in it with leverage? Just because of the risks. Just because of the risk. That potentially could shoot a hole in your boat below the waterline, simply because of the accelerated risks or the demand for cash. It just, when you invest on margin or when you invest leverage, it just throws your entire financial situation, all 6 areas, off their axis. Can you get ahead more quickly? Absolutely. Does doing so amplify risks, and is there significantly more downside? Yes, that too. So I would tell you, don't invest on margin, particularly now when you're seeing the trend that it's at all-time highs. Work with your certified financial planner on those things. If you don't have a CFP on your team, contact one on my team. Find us online, corehorn.com. That's Corehorn with a K. wisemoneyshow.com. You can find us there too, or just send us an email, info@corehorn.com. All right, there you have it. Go out and take your next wise step in your financial life.